I think we'll get started. Welcome everybody that's here live. This is my first hybrid one, so welcome everybody that's virtual. Hopefully I manage this next 50 minutes well. Couple of quick announcements before we get going too far. I think Fonda mentioned it in here, but there are microphones throughout the room, so it will pick up anything and send it out to our virtual attendees. So careful what you say. If you want to say something nice about the presenters. Also, today's Veterans Day, so anybody that's a veteran, either in the room or virtual, or if you have family members, thank them for their service. So it's a big day in America. Okay, so our basic schedule for today, we're going to do a tax update for the next 50 minutes. Then we'll have a quick intermission, and then at 10 o'clock, Terry Barrett, Kate Gottschall will do our SALT update. I am Vince Nadder. I'm one of the tax partners here at Keiter. So today's going to be a little bit interesting because we've got some rehash of some old news, some pending legislation, and some action plans that we're going to talk about. So just for the virtual folks, for the live folks, you won't have to do anything to get your credit for attendance. You've got it by sitting in here. And by the way, if you're not familiar, restrooms are just outside in the hall if you need to take a quick break. Virtual folks, as we go through the presentation, you'll see a screen pop up that gives you a code word. You'll need to not be in full screen, and you'll see the code word box there to the right. You'll click on that, type in your code word to get the CPE credit if you're here to get CPE. You'll need, there's 4 code word prompts per session, so 8 total. You'll need to get 3 out of the 4 in order to get the full credit. And if there's any questions that you have as we go along, commentary on anything that you see presented in either of these, you can submit a question there at the bottom where it says Q&A. And we've got Colin and Izzy monitoring our Q&A. So today's the tax update. Again, I'm Vince Nadder. I'm one of the partners here at Keiter. There's some things that we do know, and there's some things that we don't know, or that we think we know, or that we might know in about 2 months. So some of this is going to be what ifs, and here's what we think is happening. So we're going to start with pending tax legislation. That's maybe the majority of the presentation. And then we'll go through 2021 planning, which will include a review of the 2020 acts, and then a couple of bullet points on some action items that people may want to take in the near term. I do like to start with a little bit of levity. It'd be nice to shop around for tax rates, but I guess the only way to do that is to relocate either to Canada or France or Florida. So pending tax legislation. We've had a lot of legislation talk the last, I don't know, year and a half. So what we're going to kind of do is take a bit of a walk through the last 2 years of what we thought was going to happen, some proposed legislation that has now gone by the wayside, and where we stand today. A lot of what I tell you, you're probably just going to have to, I'll tell you this was what was proposed, and then I'll tell you that it's no longer on the table, but I think it's important to kind of see where we started, where Congress is trying to go, and where we think we are today. Also important is just to know who's in charge. So currently, as of today, we've got a Democratic president, a Democratic House, and a slight Republican Senate. Why that's important is just who's doing the negotiating, who's trying to get what taxes, what spending, and can they make everybody happy in order to get something passed. I think you've all seen over the last year and a half that it's hard to make everyone happy. So they're trying to do a bit of negotiations and get everybody on board. And that's why what you'll see is as we walk through the last year and a half, you'll see things have changed drastically in terms of the tax legislation that's been proposed. Okay, so we're going to start with just talking about Joe Biden's kind of campaign promises as he was campaigning for president 2 years ago. Again, a lot of this is more for your information. Some of it is still being considered and negotiated, and some of it is basically off the table. But his original corporate plans included increasing the corporate rate. The corporate C corporations are now taxed at 21%, which was the reduced rate that was passed by the Tax Cuts and Jobs Act back in 2017. There's been a lot of talk about the corporate rate. He was campaigning on increasing that, proposing it to 28%. Also talked about a few things at the 30,000 foot level, including a new minimum tax and raising taxes on foreign income, a lot of tax credits for the manufacturing industry, the green industry, as well as certain credits for childcare facilities and ADA compliance, as well as expanding the low-income housing tax credit. Some of the negatives of the Tax Act, where there was a lot of talk about repealing like-kind exchanges, which people in the real estate world and folks that just own real estate take advantage of to defer gains. There was a lot of talk of repealing that, as well as limiting losses for real estate investors. On the individual side, he was campaigning on basically increasing the top rate. The top rate right now is 37%. He wanted to take it back to 39.6 for people over 400,000 of income. That was his campaign. If you're under 400, you're not going to get more tax. And the 39.6 was the rate prior to the Tax Cuts and Jobs Act. That was the highest rate. He wants to get it back there, as well as the other big piece was increasing capital gains. The capital gains rates are currently 15% or 20%, depending on your tax bracket. There's been a lot of discussion. I'm sure everybody in this room has heard all of the capital gains talk and is trying to figure out, do I make moves now to get locked in for a lower capital gains rate? So he had been campaigning on taking that to the ordinary rate, which is 39.6%. That 199A deduction, that's the pass-through deduction for S corps and partnerships. It's a 20% deduction. We're talking about phasing that deduction out as well for taxpayers over 400,000. Again, you'll see a theme on the campaign promises. That $400,000 line was his kind of, we're going to increase taxes for people over 400. We're not going to touch it for people under 400. Increasing the amount of payroll that's subject to the Social Security tax, which is a 6.2% payroll tax, and increasing the child and dependent care tax credit. Last part of his kind of original campaign plan, again, some stuff at the 30,000 foot level, increasing a credit for first-time home buyers, some student loan debt forgiveness, which I think got a lot of editorial writings over the last year or two about how that would impact the economy as a whole. Reducing this estate tax exemption. Again, we'll get into this a little bit later on. The current, it was set at 10 million, but with indexing for inflation, et cetera, it's about 11.7 million today. If you die, you can give away to your heirs 11.7 million without tax, which is a pretty big number. The Biden campaign said they wanted that to be 5 million, which was, again, an older level several years ago that was increased to 11 million. There was also a lot of talk about taxing all of those assets at death, as opposed to even allowing any of this stuff to go through tax-free. Again, I'm gonna leave that at that because that's been tabled a little bit lately. So then we had back September 13th was kind of the first real plan that was put together for what they're calling the Build Back Better. And we're going to talk about that a little bit more later because there is a new Build Back Better proposal on the books to be voted on. Who knows when? My guess is, if I'm using history as an example, it'll be Christmas Eve, because that is what every practicing tax person wants, is a new bill on December 24th to try and fit into the end of the year, because that's always fun. The original Ways and Means Committee summary of the original Build Back Better had a lot of proposals in it. It was a very thick proposal, including corporate tax proposals to increase the tax on C corporations from the 21% to 26.5%. Again, that's a little bit lower than the 28 that Biden wanted, but it was a higher rate, and it included a phased structure for the C corps instead of the flat 21%. There was also going to be just a change. This 163J, if you're not familiar, it's a code section that limits taxpayers' ability to deduct interest expense on their debt based on their income. So when it was originally passed with the Tax Cuts and Jobs Act, I'm pretty sure that's when it was passed, it was applied at the entity level. This change was to apply it at the taxpayer level, meaning if it flows through from an S corp or a partnership, that's where you would do all the testing. Another big thing that gets a lot of editorial writing and commentary across at least our client base is the carried interest provisions, where it's kind of originally applied for like hedge fund managers and such that were taking a carried interest, kind of a cut on the back end of their income. They were taking capital gains rates instead of ordinary like their investors were getting. There was a lot of talk about, hey, that's unfair. You're taking a 20% rate instead of a 40% rate. It's still capital gains right now. They were trying to increase the holding period for those carried interests from the current 3 years to 5 years. Again, I think that's on hold for now. One big one that we thought we were going to be planning around, but I think this is tabled probably for good, is allowing S corps that were organized prior to 1996 to reorganize as a partnership without triggering tax. There are people that the S corp structure maybe no longer works. They want to go to a more flexible partnership structure, but they can't do it without incurring tax. So we thought there was going to be some planning around this provision in the Build Back Better, but it appears that this, unless you've seen it in the new provision, I think this is gone from the new provision.
Nobody can figure out why was it there first.
It did seem out of the blue, came up from nowhere, so it was probably somebody's special interest that they threw in there. Fortunately, somebody read the bill and it got thrown out. And they were going to terminate the employer credit for paid family and medical leave in 2023 instead of 2026, which is the current sunset. Again, keep in mind, all of these were proposals that a lot of them are now tabled, just trying to give you the history of where this thing has come from. The individual tax proposals, they did include an increase to the 39.6% as promised. They included an increase to the long-term capital gains rate only to 25%. So I kind of felt like that was a win. Instead of taking it up to the ordinary rate of 39.6%, they took it up to 25%. But really, what really irritated a lot of people in our circles is that they put a effective date of September 13th, which was the day it was proposed, which means you really had no time to do any planning. If you wanted to sell something in order to lock in your 15 or 20% rate and avoid this 25% rate, well, you were out of luck. Unless you had something already signed, you weren't going to get the lower rate, because they put this was the only one in the Build Back Better that had a effective date as of the writing of the bill. Everything else was going to be effective after 2021, meaning January 1, 22. Another big one, and this is one that we'll continue to talk about. Well, technology, hold one moment, please. I'm going to get there. Okay. Expanding the net investment income tax. So the NIIT or NII is a 3.8%, we'll call it a surcharge on passive income or investment income for certain taxpayers. When it was originally passed, it was for what we'll call passive investment income. So folks that had an S corp, an operating trader business that made $600,000 were not subject to this net investment income tax because it wasn't investment income, it was trader business income. So this proposal is saying, regardless of your participation in an active business, whether it's an S corp or a partnership, you're going to be subject to this 3.8% tax as well. That is a really big one. It was big when it just applied to interest and dividends and capital gains, because if you sell stock or you sell anything that's passive, you were going to be subject to this 3.8%. It added a lot of tax to a lot of our clients and a lot of taxpayers around the country. It was already a pretty big deal. Adding it to pretty much all income over this $500,000 line is a pretty big deal. It's effectively an increase to the tax rate without saying we're increasing ordinary income tax. We're just adding this surcharge, if you will. We talked about the pass-through, the Section 199A pass-through income. There was going to be a limitation on that deduction as well, depending on your gross income levels. And there was going to be a gross income surtax of 3% on any gross income over 5 million. Again, they're really starting to hit those big numbers that really can move people's decisions. The last bit of income tax on the original Build Back Better was some limitations on what's known as qualified small business stock gains. It was going to limit who could use that. I think there's still in the new Build Back Better some 1202 stock language. I think it's changed a little bit from what the proposal was. And this excess business loss provision refers to companies that have operating losses in their ability at the individual level to deduct them and what they can offset and how much they can use. There's a limit of how much you can use, which in this case is $500,000. This was supposed to sunset in 2027. But again, this one, I think there is an excess business loss provision in the new Build Back Better, but it's a little bit different. By the way, if you have any questions or commentary on any of these slides as we go through, you can post them online. And if we can get to them or it's where I have an answer, we will address them. The last bit of what was in the Build Back Better relates to the estate, gift, and retirement side of tax, which sometimes, well, most times impacts most of our clients and probably most of you all. Again, the lifetime exemption was going to be reduced as promised from 11.7 to 5 million. A big one was revising the grantor trust rules. Essentially, a lot of our clients or taxpayers will set up grantor trusts to avoid estate tax on certain assets, but the income tax treatment today doesn't change. So it's essentially moving assets out of your estate. Eventually, this bill was basically going to eliminate that because you were going to pay tax on it today. It was going to create a bit of a havoc in the estate planning world. But that one's off the table, at least right now. Another big one was eliminating valuation discounts when people gift or transfer assets to trusts. When you're moving it, there's a thing called valuation discounts. If it's worth $1 million, you can take 30–40% discount and say, I'm only gifting 600,000 to preserve that 11 million estate tax exemption. But this proposal was saying that's out the door. We're not giving you any valuation discounts. Again, this one is off the table, but it's giving you an idea of what they're trying to do and what could bubble up over the next few years, depending on how administrations change. Another one, which was a little odd, and again, some of these were out of the blue, was if your retirement accounts were in excess of 10 million, which I don't know, hopefully it's some of us, but it's probably a very few of us, you could no longer make contributions to your retirement account. So essentially saying you have enough. You don't need to take advantage of these tax deferred arrangements. You have enough money. We're not going to let you put any more in. And if you have in excess of 10 million, they were going to require distribution. So in other words, you got to start taking it out and start paying tax on that money. So it was, you can't put money in and take a tax deferral, and you've got to take money out and pay tax on it. So they were definitely trying to get you coming and going. But again, it's probably a very small percentage of taxpayers that have this $10 million range. Some things that were not in the original Build Back proposal were this list of items. I don't know that I need to get too detailed, but it didn't make carried interest an ordinary income asset. It did not eliminate the step up in basis for decedent's assets. It did not limit Section 1031 like-kind exchanges, keeping in mind that the like-kind exchange rules did change a few years ago where you can only exchange real property. So that was changed a few years ago. but in our circle, most of our clients were probably doing real estate only anyway, so it didn't have much of an impact on the folks that we see. We'll talk about this a little bit more, the SALT cap, the ability to deduct state and local taxes on your personal income tax return. Right now, as we speak, you can only deduct $10,000, which was a big change in 2017. You could deduct all of your taxes, income tax, real estate tax. In 2017, they said you can only deduct $10,000, which ultimately, in our world, eliminated a lot of people from taking itemized deductions at all, because that $10,000 just wasn't enough to get them over the standard deduction, which I think is like $24,000. So that impacted a lot of people. And mark-to-market rules requiring capital gains on individual assets, again, not in the original Build Back Better. So currently, the current Build Back Better. So this is it's basically subject line only of what's in the Build Back Better. The new Build Back Better, it's 28 pages and doesn't go into any detail. So there's a lot in the new Build Back Better proposal that was proposed on November 5th. So maybe, I don't know what today is, 5 days ago. So there hasn't been a whole lot of editorial or negotiations just yet, but it's what they're debating now in Congress. It's definitely a slimmed down version. The original Build Back Better was in excess of $3 trillion. The current Build Back Better spend is like $1.75 trillion. So it's still very large, but not to the extent that it was. So the revenue raisers that they needed to include, a lot of them have gone away. So the biggest and most important to note, the ordinary income tax rates have not been proposed to go up, so they'll stay where they're at under this proposal. And there's no change to the capital gains rates. So they will stay at 15 and 20%, depending on your bracket. They're not going to go up to 25% or even 39.6. So those were two, what I consider pretty big wins in the new proposal, is that those two global tax raises are not in there. Unfortunately, at least for my clients and a lot of you all in this class, it does retain the net investment income tax on your pass-through income. So for anybody that's running a business, if you make $600,000 and it passes through to you individually, that $600,000 is going to be subject to the net investment income tax of 3.8%, just like your interest, dividends, and capital gains. So it's essentially a tax increase on a lot of the folks that are our clients. One thing that it is a very unfortunate tax, but it's always a good problem to have. There's a 5% surtax proposed on income over 10 million, and there's an additional 3% surtax on income over 25 million. So this could be a very big deal coupled with the net investment income tax for someone that has something happen in 2022. Let's say they sell their business or have a huge gain transaction, and suddenly they're $30 million of income, or maybe $20 million. Their tax rate just went up 3.8% plus 5% plus maybe another 3%. So instead of a 37% federal tax rate, they might be at something much higher. So that's something to keep in mind if you've got transactions that are cooking. This could be an issue if it gets passed. Something that I doubt impacts anyone listening in, although I wish it did, a minimum tax of 15% on corporations whose financial statement income is in excess of $1 billion. Again, that'd be a great problem to have income in excess of $1 billion. This proposal's kind of in there because of, I guess, what people call the financial statement games, where a company will have financial statement income of $1 billion, but because of various tax strategies, et cetera, their taxable income is much lower, so they're paying a much lower actual income tax rate. And those instances, they're going to have to get caught up to this minimum tax of 15%. There's also a 1% excise tax on publicly traded stock repurchases. Again, probably doesn't really impact us. It's going to impact the publicly traded company, but it does impact their willingness to repurchase stock because they're going to have to pay 1% tax. This is a pretty big one, and it's taxpayer friendly. We talked about the SALT cap, the ability to deduct your state and local taxes on your personal tax return, currently limited to $10,000. The proposal is to take that cap to $72,500. And again, that number has fluctuated the last 2 weeks from 0 to 85 to now it's 72.5. I have no idea where they came up with this number, nor do I have any idea how they came up with that deduction expiring in 2031, but that's where they are. It must be some sort of calculation that they do to make sure they're on budget. But that could be taxpayer friendly, likely to every one of our clients, because now instead of deducting $10,000 on your Schedule A, your itemized deductions, and coupling that with your charity and your mortgage interest to get over the standard deduction of $24,000, where a lot of our clients are just taking the standard now because this limit has really impacted their ability to itemize. This extra room is probably going to have more of our clients taking the itemized deduction because of this new limit. And as you'll find out in about 40 minutes, a lot of states are taking action because a lot of their taxpayers are unable to deduct these taxes at the individual level. A lot of states are trying to take action so that the company can pay the taxes and avoid this limit altogether. So we'll probably learn a little bit more about that later on. And so I only had 2 slides on these ongoing updates with this new Build Back Better, just because it came out really recent, and tried to put in the biggest pieces. Like I said, there's a lot in there, credits that might impact only a few of us, and that sort of thing, but I didn't want to get too nitpicky until we get something a little bit further along. There's a ton of energy credit provisions, mostly extension of provisions that are already on the books. There's a lot of international tax provisions, not getting into that today, because international is a bit over my head, but a lot of our clients aren't really in that world, and that has changed drastically over the last two years to where getting into that too deep is probably a waste of our time. As you saw from some of the numbers, a lot of the revenue raises, the tax raises, the increases, the limitation of deductions, it's really hitting the top 0.5% of taxpayers. So majority of people probably won't get impacted by a lot of these tax raisers. It's really aimed at the top 0.5%. Now, some of us will get caught up in some of the things that do change, and maybe we'll even benefit, like that SALT cap increase. It should be noted that there is a lot of money in this bill to increase the budget for the Internal Revenue Service, $79 billion, which is intended to help with their technology and with their people, mostly so that they can come after unpaid, underpaid taxes, which in all honesty, I think is a great idea. There's probably a lot of people out there that are not paying their fair share. And when we try to call the IRS, it's absolutely absurd because we can't get through. And after 30 minutes, when we do get through, we get hung up on because, I don't know, their phone system must just cut off. So they definitely need more money. I don't know if it will help really with the budget or not, but that is a big part of this Build Back Better. A little bit more levity, and unfortunately I couldn't find a more up-to-date pictograph of the tax law, but this takes you through 2014, and it kind of includes the code, and you'll see back in 1913, it was 400 pages worth of code and regulations. If you walk through all the years and you add in court cases and treasury regs, in 2014, you're talking about over 74,000 pages. I would be willing to bet since then, in the 2017 TCJA and all the accents, it could easily be over 100,000 pages. I really wanted to find one, but I don't know if they got sued and couldn't do this anymore, but I couldn't find one past 2014. So that's all of the pending legislation. If anybody has questions on that, please let me know. What we're going to do next is talk about things that are in effect right now. Not much has changed since 2020. So we're going to talk a little bit about the 2020 stuff after these slides. The 2021 real changes were pretty limited. So that'll be a fairly quick walk. We do have your first code word. Sorry it took so long, but wanted to get through that first little bit all in one section. So make sure you go to your, get out of full screen, go to your code word and type in the code. Early 21, March 11th, the what we like to call ARPA, the American Rescue Plan, was passed. And it included a few things, mostly beneficial to taxpayers. If you recall, back in 2020, there was the first rebate check, stimulus number 1, and then there was a stimulus number 2. And I'm not remembering the numbers, but I think it was like 1,600 and 1,200. Stimulus number 3 was part of ARPA. It was 1,400 per person, and dependents could also get the 1,400, but it was phased out for gross income over 150,000. You either got a check. If you got a check, it was probably based on your 2020 return, maybe your 2019 return if you hadn't filed your 20. When you file your 2021 return, there's going to be a calculation that's going to true up. You won't have to pay anything back. But if you didn't get a check or you only got a partial check and you're eligible for more, you will get more on your 2021 return. Very similar to 2020 and the first 2 stimulus payments. It's based on your income. If you didn't have a filed return on record, they guessed at it based on your old stuff and sent you a check or didn't send you a check. And it's very possible you didn't get a check at all because 2020 income was high. 2021 income comes down, you'll get the full check, which is great. But just beware. So as your tax preparer is asking for stuff, make sure you're aware that, hey, did I get a stimulus check? How much did I get? And let me provide them that information so that I can make sure if I only got 800 and I should get another 600 or 800, whatever it should be, make sure they have that information. For 2021 only, the child tax credit increased from $2,000 to $3,000. And for children under 5, it went to $3,600. So again, on your 2021 return, these things will be very important to have the information so that we can get the right credits. Or if you're preparing your own, make sure you have your eye on it. The extra credit is phased out. For married filing joint, it's phased out at $150,000. Another big change for 2021 is that children who are 17 qualify for the credit. Prior to this, it was under 17. So you picked up an extra child, depending on their age. Whoops. Okay, yes, sir.
Will government provide any 1099 or similar form to show what was sent?
They usually send a letter, either with or after the check. I don't think they're going to send a year-end document. So if you got a check, you should have gotten a letter, or it might just have been your stub. Although a lot of these were direct deposited. So again, you should have gotten a letter. If not, I'm fairly confident you can go on irs.gov and search. I'm not 100% sure about that. Jim, can you do some research for me while I finish talking? This is pretty good, this whole hybrid live thing.
They're not going to send a year in.
They won't send a year in, but you should get something when you got the check, I believe.
Yeah, there's no statutory reporting requirement.
Okay, no statutory reporting requirement, if you could hear Mike, but we're going to see if there's an irs.gov that you can go in and plug in your social and see if you got a check or not. I believe that's the way.
The transcript should be on.
One big difference with this the child tax credit. Thanks for the question. That was a really good question. I sent it in earlier last night. It was my question. This year, the IRS started sending advance payments for the child tax credit. So some people started getting checks and didn't know why they were getting checks, or, hey, should I even cash these? What is it? They were advancing based on your 2020 return if you were qualified for this tax credit in order to spur the economy on and to help taxpayers. They were sending advanced tax credits for about half of what you should have gotten. So they were pre-funding your credit, which is also going to be very important when you file your tax return to know how much of the child tax credit you've already been advanced, so you don't double dip. And trust me, you're not going to want to double dip because they will come after you. Yes, ma'am.
Any statutory reporting requirement on that number?
And they should be sending letters with, here's your check for $121.22 or whatever it is, because they were taking half and paying it out over 6 months. So you should get 6 checks that you're going to have to report on your return, and you'll match that up with what you should get, and you'll get the difference. Or you might owe it back, because if you qualified in 20, you don't qualify in 21, you're going to owe that one back. That's different than the stimulus number 3. If you got it and you didn't deserve it, well, you win. The child tax credit, if you got it and you weren't eligible, you're going to have to pay it back. Another extension was the child care tax credit. Taxpayer friendly. They increased the percentages that are eligible. They increased the amount of qualifying expenses that are eligible. And the AGI phase out went higher. So the max credit went from 35% to 50%. So, and the qualifying expenses went from 3,000 to 8,000, and it could be 16,000 for 2 or more qualifying children. And the phase out went up to 125,000. Pardon me, but I don't remember the previous phase out, but I think it was 75,000 or maybe 100. So all of those numbers for your child care credit have gone up. So if you're single and you're working and you pay for childcare, you get a credit. Keeping in mind you can't what I'll call double dip and have monies withheld for dependent care assistance and avoid tax on it there and get the credit. The form will help calculate the delta. Yes, sir.
So I looked up for the stimulus checks, and you have to create an account with the IRS, which is kind of the process. I actually couldn't get into my account for some reason. It's not very easy. And from experience in the child tax credit, I don't think that they even notify you that you're getting, like, I've seen it just kind of show up in accounts.
So they're just direct depositing.
And I was
Stimulus
hoping there was
money.
going to be some sort of year-end reporting on that, but I don't know if there is or not, to be honest with you.
So we're going to need people to look for the stimulus and look for the child tax credit deposits.
It'd be really nice if they put something on the end of the year that tells you how much you got. So we don't need that.
Okay, that might be worth additional information. Sir.
Jim made a good point. They have this new procedure that came out earlier this year about people getting access to the website. That, as Jim said, you have to go in to that website and create your own account to be able to access this stuff. It's kind of a pain in the neck to do it, but in order to look at it and stuff, we have to do that.
IRS.gov, yes. Yes, ma'am.
I was just gonna say that I didn't turn mine off. I tried to turn it off, but I didn't find. I got 4 different amounts for 4 months.
They were all different amounts. They weren't even the same amount. And did they just show up?
Yep.
Any letter with them? So at the end of the year, you're going to have to go, if you don't remember, you're going to have to go look for them.
Same with the stimulus payments that happened in 2020. They just showed up, no correspondence about.
Yeah, but with those, you don't have to pay them back. With child credit, you
Gotta
do.
pay it back.
So it's a little frustrating.
So ARPA, 3 pretty big changes, basically taxpayer friendly, stimulus, the child tax credit, the child care tax credit, keeping in mind on the child care. Oh, that's where I was going. You must have earned income in order to get the credit. So if you aren't working, let's say you're married, wife is a CPA at Keiter, husband stay-at-home dad, but you're also paying for certain childcare during the week, you're not going to get a credit because husband is not working and he does not have earned income. Both spouses have to have earned income in order to get this childcare credit. 21, again, further changes, brackets have not changed. Slight changes in kind of where they break to get to the 37% top rate. 0% qualified dividends and long-term capital gains still exist for married filing joint. If you're under $80,000, your capital gains and your dividends are at 0%, and your 20% rate kicks in for married filing joint at 473. If you recall, last year required minimum distributions. You could opt out and skip for 2020. You cannot do that in 2021, so you got to get back on the train and take your RMDs. I want to make sure we cover the rest of the slides. Some of these I may skip over fairly quick to make sure we kind of hit the action items. Charity, if you're not itemizing, you can still get a $300 or $600 deduction. You know, a lot of our clients weren't taking the itemized, but still gave charity, so you get a little bit of a bip there. Unemployment tax in 2020, there was a law passed late in the year that $10,200 was not going to be subject to federal tax. For 2021, that is back in. Unemployment is still going to be taxable. I believe I read something in the new Build Back Better about unemployment, but it wasn't quite, it didn't give enough detail to say, oh, this person's going to be eligible for exemption and this person's not. So stay tuned on that for unemployment income. Employer retention credit extended through 12/31/21 originally. Keep that in mind because we're going to get to the most recent tax bill, the infrastructure bill, in just a sec. I'm not going to go over that. The annual kind of gift exclusion is $15,000 still. Any person can give to any other person a $15,000 gift without any tax consequences. And if it's straight cash, you really don't have to report it. Second code word. Well, I got to get through these code words. Second code word.
Hence the annual exclusion goes to 16,000 next
And 22.
year. 22.
In 22, it goes to 16,000. One thing for our business clients and for folks that are running a company, business meals. This one to me is kind of a big deal just because of the context behind it. Historically, business meals have been 50% deductible. There needs to be a ordinary and necessary business purpose for the meal. For 2021 and 2022, those are going to be 100% deductible. So tracking your business meals separately is very important, especially separate from your entertainment, because entertainment is still non-deductible. So it needs to be from a qualified restaurant. It doesn't necessarily have to be going in and sitting down, but it can't be buying stuff from Publix and bringing it in and eating at your desk. It has to be a restaurant provided meal. Again, keeping in mind any part that might be entertainment, you're going to need to segregate that because that's going to be non-deductible. All right, the most recent bill that was passed on November 5th. And like I said, things are very fluid and who knows how many more bills we'll get this year, maybe one, maybe more if they break it up. It's the Infrastructure Investment and Jobs Act. I'm not sure if anybody's come up with a cute title or for that one just yet. So we're just going to call it the infrastructure bill. Very limited tax consequences. The main one is terminating the employer retention credit early. It was originally passed. It was going to expire at the end of 2020. Then a new bill came out and said we're going to extend it through all 4 quarters of 2021. Actually, the original might have expired June of 21. They extended it to include 3rd and 4th quarter of 21. This bill says, nope, 4th quarter's out. The ERC is done after 9/30. So it's only for Q3 wages. There is new information reporting for crypto assets, meaning cryptocurrency basically, but digital assets, et cetera. So there's going to be 1099 reporting for that, for brokers and dealers of crypto assets, and a disaster relief extension. I'm not going to do much on the Families First Coronavirus Response Act or the Coronavirus Aid, Relief, and Economic Security Act, because those were covered in great detail last year. I will roll through the slides real quick, but you will get the slides post-class, so you can certainly go through it. One of the big ones is net operating loss deductions. that you could carry back 5 years. That's a big deal for companies that were really losing money during the pandemic. Excess business losses, I'm not going to really go into that. The Secure Act is, has a few good items. This was passed in early 2020, mostly related to, gosh, I wish I remembered the language. Secure is, I forget what it is, but it stands for something, and it's really odd. And I
It's mainly retirement plan changes.
was just trying to remember like all the words that go with SEC, URE. It was a little bit, they really forced that one in there. The retirement age changed where you have to start taking money out from 70.5 to 72. That's something of a big deal. You get an extra year and a half. Qualified charitable distributions, and you can redirect funds from your retirement account, from your IRA into a charity. The benefit of which is you take a required distribution, but it doesn't come into your taxable income because it's going over here to charitable organization. So instead of taking the money, paying tax on it, and then giving it to the charity, you essentially just transfer it over to them, and it's typically a better result for you because you don't have to pay tax on it. You don't get the deduction, but you're not picking up the income. They changed the inherited IRA rules. When you would inherit an IRA, you could stretch it out over your lifetime. Now they're saying if you inherit an IRA from someone, you have to take it out over 10 years. Third code word. We're going to get to code word 4 very quick. All right, action items. Consider converting a traditional IRA to a Roth IRA. Every person's situation is different, so it's not a no-brainer. It's not like, oh, just do it, because you do incur tax. You're going to pay tax on the amount that you can convert right now, but then the Roth will grow without tax for a long time, and you'll take it out, and you're already done. So it depends on the time value of the money and your age and the growth. So, but consider it, because Roth IRAs are very powerful. Managing your investment gains and losses, gifting appreciated stock is a very good tool before the end of the year. If you've got stock that's gone from $100 and now it's $1,000, instead of selling that and paying tax on the $900 gain, you just gift the stock, you get a deduction for $1,000. There are options to purchase state credits or receive state credits through the various places, land preservation credits or the Neighborhood Assistance Act, where you donate to a qualified charitable organization, you get a 60% credit. Very good deal. So be on the lookout for that to help with your state tax situation. But they have in the last few years become a little bit more limited. We talked about some of this stuff, conversion to a Roth. This is one, I'm not going to go into the bullet points, but the last one, with things changing so drastically, if you have an estate plan, if you have a list of assets, if you have a will, don't just tuck it in your safe and leave it for 15 years, because in the last 5 years, stuff has changed drastically, especially if something happens with grantor trusts or with the max exclusion. You need to be looking at your estate planning docs very often. And I recommend using a lawyer for that as well, because it's really important to make sure what you want to happen actually happens. Where's my fourth code? I don't see it. Oh, gosh, almost got away with it. Almost got through the presentation without saying PPP. But a lot happened in 2020, and some of that's going to kind of come to fruition in 2021, whether you've gotten forgiveness, whether it hits your tax return, even though it's tax exempt. It will hit your tax return if it was forgiven in 2021. Keeping in mind state conformity, specifically Virginia, it is taxable in Virginia. Anything over $100,000 is taxable in Virginia. So if you had a $300,000 PPP loan, that $300,000 is tax exempt federally. You're gonna have a $200,000 hit to your Virginia return. Every state's different. they treated it different. So if you're in another state, be careful. That's all I'm going to talk about states because we've got much smarter people coming up in just a minute. Am I missing a code here? Oh, here we go. Is this it? Okay, I see it. If you have questions, feel free to reach out to me directly or Q&A here. I appreciate your time and attention. And here's your fourth code word. Put it in before you go get your coffee. Thanks, everybody.